It's important to have a good mortgage specialist. You see, the mortgage specialist will really sit down with you, and they don't necessarily want to sell you a mortgage. They want to sit down with you, look at your financial situation. That income, is it variable? Is it stable income? What is your debt load? Do you have accumulated debt from student loans, from just getting married, for example? And you have to look at what the financial situation of the client is going to be once they own the home, over the short and long term also. It's very important to deal with somebody you can trust. Preferably somebody who deals with a very large financial institution. The 6 major Canadian banks are, they have guidelines they need to follow under the Canadian Chartered Bank Act. So we are very regulated large banks. Some mortgage brokers deal with financial institutions that are not regulated or that are outside even Canada, namely Australia or the US. And it can be tricky for Canadians to deal with those institutions. Sometimes they're attracted by an interest rate that might be a little bit lower, but in the end, those companies can charge fees, etc. And in terms of serviceability, sitting down with people if there's a problem, reevaluating, changing the mortgage around, it can be very difficult. It's really best to work with somebody you can trust, somebody preferably that's referred by a friend or family. But most important point, deal with a major Canadian bank. That way you have no surprises. The minimum amortization period is 5 years, but some people do take a mortgage over 5 years. Some people who, for example, will put a very large down payment and take a small mortgage, $50,000, $60,000, and they want to get rid of it very quick. Some people don't like to have debt, so they take it on a very short amortization period and pay off the home very, very quickly. But the standard is 25. If you take a 30 or 35 year amortization, you will have a lower monthly mortgage payment. But all banks allow you to pay your mortgage down faster. So you can do double up payments, you could do lump sum payments on your mortgage during the year. So whether you took a mortgage on 30 or 35 years, you can easily pay it off in 15 or 20. When you go to the notary, you sign a document called a deed of loan, and that deed of loan has a shelf life. So if you signed a document that is valid for 25 years, you can't extend the life of that document. You'd have to go back to the notary and sign a new document. On a mortgage, there has to be a set term, whether it's a 1 year term, 2, 3, 4, 5. Those are the most common terms. But in Canada, if you're signing on for a fixed term, that term cannot change. So if you're signing in for a 5 year contract, a 5 year term, you want to make sure you know what that rate is for the full duration. You don't want it to be reevaluated. The best way, I think, to find a mortgage broker is to ask maybe the real estate agent that you're dealing with. But the important thing is to deal with somebody you trust. A mortgage is something for the long term. It's not a disposable product. It's something so that you're going to have for years to come, and it's usually the biggest financial investment you're making is your home. And we all work on repeat business, referral business. So a real estate agent will not take a chance to refer a mortgage specialist to a purchaser, a home purchaser, unless they know that he's going to take good care of their clients. We gather the data, which is we need from the real estate agent the purchase contract, the offer to purchase. We need the property description so we know what the client is buying and what ultimately the bank will finance. So we usually get that information from the real estate agent. The next step is getting the data from the client, who will be ultimately the borrower. So we need information relating to their work income, whether they're self-employed or employed. We need to check their credit rating, and then we need to make sure that they have an available down payment. We check something that's called a debt servicing ratio. So we look with the monthly income earned by the individual or the household, what percentage of that income will be used to service the mortgage, the municipal taxes and school taxes, and the heating. And we like to see that those expenses don't exceed about 1/3 of the client's monthly income. We like to see that the client's total debt ratio is around 40 to 45%. A client doesn't need to have perfect credit to be a homeowner, to have a mortgage finance. but he needs to have decent credit. Most people have an R1 or an R2. That's the language we use in the credit business, which is being late for 1 or 2 months somewhere on the line on a credit card, on a car payment. It can happen. Those things, as long as they're isolated incidents, it's okay. If there's a pattern that the client is late on multiple things very often, especially if it's in the near future, in the past year, well, then that raises a flag, and then we investigate a little further. Somebody who has a decent track record, even if there's a few hiccups along the way, that'll be fine. Financing should be approved if, again, stable income and the debt servicing ratios are acceptable. People can miss a mortgage payment. Most banks actually allow you to skip a payment here and there. So when you skip a payment, essentially what the bank does is they will simply take that payment and carry it to the end of the mortgage. There's also extended skip of payments, which is if you have a very valid reason, like major illness, loss of a job, a bank can accept to do a temporary hold on the payments for a determined amount of time, 3, 4, 5 months. Plus, a lot of banks allow you to double up your payments. If your payment is, let's say, $1,500 a month, you can pay up to $3,000. Every time, the bank I work with, RBC namely, every time you make a double payment during the year, that allows you to skip a payment down the road. The minimum down payment in Canada is 5%. A lot of people still think that it's 0%. That used to exist until October 2008, when the Canadian Mortgage Housing Corporation discontinued that practice. So there is a minimum down payment of 5% that needs to be put forward in the purchase of a home in Canada. If you put between 5 and 20%, your mortgage, the lending institution is the bank you're going to deal with, but the mortgage needs to be approved by the federal government, by CMHC. When you reach the 20% down payment level, your mortgage is conventional between you and the bank. The federal government is no longer involved. The mortgage rate is not affected whether you are putting a large or a small down payment. A bank will use an automated appraisal system. That is, they will put your home address, the size of the house, the year it was built in, is it a bungalow, is it on 2 floors, does it have a garage, what type of heating system. So they fill up that data in this automated appraisal system, if you will, and by postal code, the system will go and verify in your immediate area what the median house price is. And if the value that was input, or the value that was given by the client, is within the range of the transactions in that area, well, the valuation will be accepted as is. Well, most banks have a way to deal with that. So, for example, you signed on for a 5-year fixed term, so you are in a closed contract with that institution for 5 years. Let's say you sell the property after 3 years, you will have a few options. One is to transport the mortgage to the new property. You can also opt, if you are not buying another property, to transfer your mortgage to the person buying your home. So Mr. A sells the home to Mr. B. Mr. B comes to the lending institution and takes over the mortgage. Again, you're off the hook if you want, because if you do break the contract without transferring the mortgage or transporting it to another property, you will be then subject to pay a prepayment charge, also referred to as a penalty, to the financial institution.